Okay, so we are all living through the AI revolution, right? We see the headlines, we use the chatbots, we've all watched those tech stocks just go to the moon. But today, we're going to look past the glowing screens. We're going to get beyond the lines of code. We're pulling back the curtain on this AI gold rush to show you the massive, tangible, physical transformation that's happening behind the scenes. And that shift brings up a fundamental question.
And this is it. This is the central debate right here. On one side, you have giants like BlackRock saying, look, this is a productivity boom, you have to invest. But on the other side, you've got respected firms like GMO waving these giant red flags, calling it an extreme bubble that's just waiting to pop. So which is it? Is this the foundation of our entire future, or is it just a massive house of cards? That's what we're digging into today.
You know, this quote right here perfectly captures the big idea of this explainer. It says, most of us investors are like these fishermen, right? We're all geared up to catch herring, the small, obvious fish. In AI, that's the software, the models, the stuff we see every day. But swimming right under the boat, deep down, are these giant salmon, the massive, less obvious opportunities in the physical world that actually make this whole thing possible.
All right, so here's our game plan. We'll start with the gold rush everyone's talking about. Then, we're going to bust some of the biggest myths around AI being purely digital. From there, we'll dive into the new reality, what's called the business of atoms, and see how that's leading to the rise of physical AI. And then we'll make it practical, how to invest in the enablers of this revolution, and, super importantly, how to navigate the very real bubble risks.
Okay, let's kick it off. Section 1, the AI gold rush. This is the story you already know. The Magnificent Seven stocks, led by NVIDIA, Microsoft, they've just completely dominated the market. And we've seen this absolute explosion of chatbots and generative AI that's grabbed everyone's attention and sent stock prices soaring. This is the public face of the AI revolution.
But that familiar story is really just our starting point. In this next section, we're going to start pushing back on those common narratives. It is time to bust some myths, because what's actually happening on the ground is so much more complex and, frankly, more interesting than what the headlines are telling you.
And here is myth number 1, probably the most important one to get. We think of AI as this thing that just lives in the cloud, right? Purely digital? But the reality is that AI is a business of atoms. For every single brilliant algorithm, there is a massive, dirty, physical footprint. Its success depends entirely on real-world stuff. Getting permits for power grids, finding enough water to cool down data centers, and literally building these gigantic specialized facilities. Trust me, without the atoms, the bits just don't work.
Myth number 2, that all of big tech is riding the exact same AI wave. That's just not true anymore. Not even close. Their strategies are splitting apart and fast. The performance gap between these stocks has actually widened over 50%. And why is that? Well, you've got companies like Meta and Google going all in on building their own super expensive AI models, while folks like Microsoft and Amazon are focused on building the plumbing to run everybody else's models. They are not the same bat.
And of course, the huge one, what about our jobs? The myth is that mass layoffs are just around the corner. But the reality right now is a phase some are calling super staffing. So instead of thinking of AI as a replacement, think of it as a super-powered colleague, almost like a chief of staff for every employee that boosts their productivity. And while, yes, some models predict job losses down the line, other studies show that jobs with high AI exposure are actually seeing higher wage and job growth at this moment. The story is way more complicated than the robots are coming for your job.
So once you bust those myths, a whole new way of looking at this emerges. One that's grounded not in the cloud, but right here in the physical world. This is where we pivot our focus to the business of atoms, the concrete, the steel, the power lines that are the true foundation of this entire AI revolution.
Now, to really get this physical build-out, you have to understand this key term, the industrialization of inference. It sounds technical, but it's simple. For years, all the money and effort went into training the AI models. Now, the real money is shifting to inference. That's the AI actually doing stuff. So think less about asking a chatbot for a recipe, and more about an AI agent that can find the best prices for the ingredients, place the order, and schedule the delivery, all on its own. The value is moving from just being a tool to getting real-world tasks done.
And that shift means we need a whole new physical setup, this 3-tiered architecture. You still need the giant cloud data centers for training. You need that flexibility. But for running those tasks efficiently, companies are now building their own on-premises data centers. And then, for things that need an instant response, like a self-driving car or a factory robot, you need the computing right there, on edge devices. It's becoming a huge distributed physical network.
And what does every single one of those data centers need? Power. A mind-boggling amount of it. Just look at this chart. AI data center demand is set to absolutely skyrocket to 156 gigawatts by 2030. And this creates a really scary risk of what's called stranded capital. Imagine spending billions on the world's most advanced chips only to find out you literally can't plug them in because the grid can't take it. That's a real threat.
The scale of the money pouring into this is it's hard to even wrap your head around. Worldwide spending on AI is projected to hit $2.5 trillion in the year 2026 alone. And this isn't just cash for software companies. A massive chunk of this is going directly into building out all the physical stuff we've been talking about. So this brings us to the next great leap. All this infrastructure isn't just about making our chatbots a little bit smarter. It's about enabling AI to jump off our screens and start operating in the physical economy, completely changing how we make things and how we move things.
And this is happening on two amazing frontiers that are now starting to merge. First, you have agentic AI. This is the brains. Think of autonomous agents like that coding bot Devin that can take a goal and just execute a complex plan. Then you have physical AI. This is the bodies. This is where you fuse those smart models with robotics to give them hands in the real world, doing everything from running warehouses to, yes, humanoid robots on a factory floor.
And if you want proof this is real and not some sci-fi dream, look no further than this. SoftBank's massive $5.4 billion deal for ABB's robotics arm. That was not a simple business deal. Their stated mission is to fuse artificial superintelligence with industrial robots. That is a massive signal that the world's smartest money is betting big on giving AI a physical body to interact with our world.
So the big question is, how does an investor play this? The framing shifts. It's not just who makes the best AI model. It's more like, okay, the chips are built. Now, who's actually putting the robots to work on the factory floor? And this leads us to that classic picks and shovel strategy. During a gold rush, you can bet on one miner striking it rich, or you can be the one selling the picks and shovels to all the miners. We're looking for the suppliers.
So who are these suppliers? Well, it's the obvious stuff like the companies upgrading our power grids. It's the thermal management experts creating wild new cooling systems because these chips run so hot, old school fans don't cut it. But let's go a layer deeper, especially with physical AI. Think about the Tier 2 suppliers making the precision sensors and actuators, the literal nerves and muscles of the robots. The brutal truth is, building robots takes a ton of cash, and most startups will fail. So the smart money might be on the enablers who already have cash flow from, say, traditional automation and can actually afford to survive the journey.
Now, if you prefer a broader approach, you can get exposure to these themes through ETFs. You've got VGT for broad tech, heavily weighted in the Magnificent Seven. There's AIQ, which is more focused on companies directly in the AI space. But check out Power. This is an ETF focused specifically on power and energy infrastructure. Its top holdings are utility companies and the folks who make great equipment. It's a direct way to invest in solving that energy crisis we were just talking about.
Okay, we have to talk about the risks. We just have to. With this much money and this much hype flying around, the potential for a bubble is absolutely real. And to be a smart investor, you have to understand the pressures that are building up in this system.
This chart right here visualizes the single biggest worry. Look, right now there's an estimated $400 billion or more being spent every year on AI infrastructure. But that fire hose of money is only generating about $100 billion in new revenue. That huge chasm between spending and earning, that is the textbook definition of a speculative bubble. The hope is that revenue will eventually catch up. The risk is that it never does.
And it feels like we're entering a classic phase of the technology hype cycle. After that initial peak of inflated expectations, where every new chatbot seemed like the future, we're now sliding into what they call the trough of disillusionment. The initial buzz is fading, and now investors are getting serious. They're shifting from just build it bigger to asking, okay, where's the budget discipline? Show me a path to actually making money on this.
And let's wrap up this risk section with a really sobering number. Vanguard, not exactly a firm known for wild predictions, estimates there's a 25 to 30% chance that this entire AI wave just fails to deliver the productivity boom everyone is banking on. And if that happens, today's sky-high valuations become completely unsustainable. The stakes are incredibly high.
So, we want to leave you with this final, really thought-provoking question that kind of brings it all together. For years, the big fear has been automation, right? The question was always, are we going to run out of jobs?
But at the exact same time, there's a slower, maybe even more powerful trend: demography. And that trend asks the complete opposite question: are we going to run out of workers? The real future and the ultimate impact of AI probably lies somewhere in the complicated answer to both of those questions. And that is a tension that is going to define the next few decades. Thanks for joining us.